Bankruptcy is not a return problem, it is a probability problem. Most investors calculate expected returns. Very few calculate the probability of ruin. But wealth is not destroyed in the average, it is destroyed in the tail. The greatest capital allocators in the world understand one rule: you must survive. Only then can you compound. Survival is not a slogan, it is a mathematical constraint. If the probability of ruin is greater than 0, compounding becomes mathematically irrelevant. Most investors maximize expected return. Very few minimize probability of ruin. But if P ruin greater than 0, expected value becomes irrelevant. The greatest capital allocators do not maximize return. They eliminate ruin. Insurance companies receive cash today. Claims are paid in the future. The time gap creates float. Float is temporary capital that does not belong to you. Float is not free. Float has a cost. Cost of float equals, if underwriting is profitable, then the cost of float is negative. You are being paid to hold capital. Most companies borrow at a cost. The great ones structure capital at a profit. Debt requires interest payments. Float does not require fixed interest. Debt has a maturity date. Float renews as long as policies are written. Debt is a liability. Float, when priced correctly, becomes a structural capital. Debt makes you dependent on capital markets. Float makes you dependent on underwriting discipline. Buffett chose the second. Debt has a clock, float does not. Debt must be refinanced. Float renews as long as underwriting remains rational. Time, combined with low-cost capital, creates a structural compounding. By the early 2000s, Berkshire Hathaway controlled tens of billions in insurance float. That capital did not belong to Berkshire, but it was fully deployable. Buffett used float to acquire durable businesses. The key was not the asset, the key was the capital structure behind the asset. He did not just invest, he engineered his cost of capital. Most investors analyze assets. Buffett analyzed capital structure. Return on assets is only half the equation. The other half is the cost of capital. Most investors assume capital has a cost. Buffett restructured that assumption. If the cost of capital is positive, returns are compressed. If the cost of capital is negative, returns are amplified. Debt leverage has 3 constraints: interest, maturity, refinancing. Float leverage removes those constraints. Buffett did not use Wall Street leverage. He used a structural leverage. Structural leverage reduces fragility. Liquidity creates optionality. Most investors see cash as idle. Buffett sees cash as a perpetual call option. A call option gives you the right to buy, not the obligation. Cash gives the same asymmetry. You act only when prices collapse. When markets panic, liquidity becomes scarce. Scarcity increases power. Buffett does not hold cash out of fear. He holds cash because volatility creates pricing errors. Liquidity enables action. Survival protects capital. Float structures capital. Liquidity deploys capital. That is capital architecture.